Today I'm going to share how to hit the jackpot with dividend growth stocks. It's funny, a lot of people out there, investors, they think that one has to invest in tech stocks and growth stocks to hit the jackpot. That is not the case. I have personally hit the jackpot with dividend growth stocks. I'm going to share an example from my personal portfolio today. I'm going to share what I've learned over the years, how my strategy has evolved, how I'm looking at things a little bit differently now in 2018. So this is going to be a really exciting video. Let's get started. So I'm going to jump right into it. I purchased this stock, Reynolds American, ticker symbol RAI, back in 2008. I'll link in the description below. This is right after the financial crisis, the Great Recession. I was rebuilding my portfolio because right before the crash, I had sold most of my dividend stocks, most of my dividend portfolio to finance the purchase, the down payment of our first home. Anyways, I was rebuilding my portfolio. One of the first stocks that I bought, I think the first stock I bought, was Reynolds, ticker symbol RAI. I'll also link in the description below. I have another video about a stock I own called Altria, ticker symbol MO. In terms of full disclosure, I am long on Altria. I own that in my portfolio. I bought that right after the Great Recession as well. So when the Great Recession hit, when I was rebuilding my portfolio, I saw a lot of value in this one particular industry, great starting yields, a lot of value. So I went with a real concentrated approach. And quite frankly, I didn't have a ton of cash on the sidelines. I kind of had an all-in strategy. I'll link again in the description below. Did a video about that. So I went all in. And so I bought Reynolds American in 2008 for $46 and change. And in 2010 and 2015, they split their stock. They did a 2-for-1 split. They did another 2-for-1 split. The split doesn't create any inherent value. There's no value, no magic from a split. But what it does is it makes the shares more manageable for retail investors because it brings the share price down. And it's the reflection of a well-managed company. Well-managed company tends to split its stock because the stock is going up. I'll link in the description below, again, to a video I did about stock splits. Anyways, my adjusted cost basis comes down to an 11.535 after all these splits. Really cool stuff, doing really well. Capital appreciation is great. Anyways, fast forward to 2017. They got bought out. They got bought out by a company called BTI. In terms of full disclosure, I'm long on BTI. I own that in my portfolio. They got bought out for stock and cash. And so the cash payout per share was $29.44. So for each share of RAI, I received $29.44 in cash. And then BTI also paid out a 0.5260 BTI shares per share of Reynolds that someone owned. And the 0.5260 multiplied by the price of BTI at the time, $69.25, the cash equivalent of these shares was 36.4255. So what's cool is that the stock payout was actually larger than the cash payout. I don't really like acquisitions. In this case, I kind of liked it because I think RAI, Reynolds, was a little small and they need to be part of BTI in this industry that faces a lot of criticism. And so being part of a bigger company in the scheme of things, I think is probably better. So this is, usually I don't like an acquisition. I think in this one case, it's probably a good thing. And I like how it was handled with a lot of stock, some cash, but nice that over half came in stock. What did I do with the cash, by the way, after the acquisition? One, I held onto the stock. Before all of this, I already owned BTI. But what I did with the cash is I think I bought more BTI. I might have bought some other similar companies in the same industry as well, but I'm pretty sure I kept it in the industry. Anyways, when I sum up the $29.44 cash payout, the 36.4255 cash equivalent of the stock payout, the total acquisition price all in for per share of RAI came out to about $65.87. So when I bought in 2008 for adjusted 11.535 and I cash out for 65.87 in 2017, that is a staggering gain. It is a staggering gain of 471%. This is the magic of dividend growth investing. This is dividend growth investing beating the S&P 500. I did 471% capital appreciation gain 471% gain on the capital appreciation. The gain on the capital appreciation of the S&P 500 during the comparable time period was a 153% gain. So this doesn't even include dividends that I receive, and this stock pays a healthy dividend. We'll get to that in a minute. But the point here, the point of this video, is it is totally possible to beat the S&P 500 handsomely with these traditional dividend stocks. It just so happens that it really matters when one buys them, and you have to buy them at a point of value. And this is what I was doing back in 2008, 2009 when I was buying up my Reynolds, my Altria. I saw the value, and lo and behold, I was rewarded over time by beating the S&P 500 with these companies. So fun stuff. So anyways, going back here now to more. This isn't it. What's interesting is it gets even better. The dividend. Reynolds, before it was acquired, paid a dividend of 51 cents a quarter. Multiplied by 4 quarters in the year, it comes down to $2.04 per year. I take the 204, I divide by my purchase price, adjusted of 11,535. My yield on cost was a 17.69%. This is where it's interesting. Not only did I beat the S&P 500 handsomely on my capital appreciation gain, but also the dividend alone yielding 17% yield on cost. Let's say it was never acquired. 70%. By comparison, the S&P 500 historically, it's driven an 11% return per year over time. Well, when Reynolds was acquired, I was getting 17% a year just in cash flow. So it's beating the S&P 500 just through the cash dividend. And so this is, again, an example, it's a real good example of hitting a home run, of hitting the jackpot, beating the S&P, doing really well. And what was the magic behind all of this? The magic is that I got lucky enough to buy at a real deep value. I bought a company that had a really good track record, raised the dividend over time, shareholder friendly, and I bought it, a company at a good price. I bought it at a really good price after the Great Recession. And so the takeaway here is 2018, it's a little bit different than 2008. Look, the kind of value that was there in 2008, 2009, it was widespread. It wasn't just in this industry, it was in a variety of industries. But in 2018, I think there's some value out there. I'll link in the description below. I own stock in IBM. I think IBM is one that's trading at a value right now. Is it the kind of value that RAI was at? Honestly, maybe. I think it might be. And I think it'll take time to realize the gain there. They have all these patents. I think they have to see quantum computing, blockchain, and artificial intelligence all take a stronghold. So it's going to take time. I'm patient. That's the other thing, is I'm just real patient. I don't need the capital appreciation. I don't invest for capital appreciation. I invest for the dividends. I want to live off of dividends. So I'm sharing capital appreciation here, quite frankly, because that's what people look at. That's what everyone looks at. And so I have to share it here as an example, because that's what most people, most investors look at. But for me, I actually don't look at it. Look, if I didn't even get this capital appreciation, if it was never acquired, I'd totally be happy with my 17+% in growing yield on cost. It'd probably be over 20% right now, just like I am experiencing on Altria. I'll link in the description below. Did a video recently on Altria. I am yielding 20% yield on cost. First time I've done that in my portfolio. Real excited about it. And I would have been doing the same here if it weren't acquired. I'm rather just have that yield on cost keep going up than face acquisitions, face capital appreciation. But again, it kind of all worked out for the best here, because Altria is a bigger company. Reynolds kind of small. I think Reynolds as a standalone would have faced some challenges over the long run. So I think it's better that they're completely part of BTI. BTI actually already owned a bunch of them. They bought all the remaining amounts. So now they're fully integrated companies. Good stuff. So what did I learn from all of this? Am I doing this just to brag? Heck no. I've made my fair share of mistakes. In that video I just did about the Great Recession, I shared how I made a ton of mistakes. One really big one in terms of what I was telling, what I was suggesting to my wife at the time on some of the remaining stock holdings that she had. And so check out the video. When the crash comes, you don't know how you're going to react. And I got lucky. I had some successes, but I also had some mistakes and some lessons. That's how it is being an investor. And that's after 10 plus years of investing. I still, during the Great Recession, now it's been 20 plus years, but I'm always learning. I'm a lot better now than I was in the Great Recession, but even 10 years into it, 10 plus years, I was learning so many lessons, and it's great. Anyways, what did I learn just from this example? Why am I sharing it? Bear market investing is different than bull market. We're in the bull market now. One has to have realistic expectations. I have to have realistic expectations. Everyone out there should. It's important to have realistic expectations. Is this possible? Yes. Is it going to be widespread like it was people buying at the trough of the bear market? Not necessarily, but like I said, I feel good about IBM. I feel good also about Cedar Fair, ticker symbol FUN. I own that one. I'll link in the description below. Totally don't see the kind of upside on that like I have here, but I think there's some nice upside. I feel good about buying it now. But it's different. That being said, I'm buying. I buy in bear markets, bull markets. I'm always buying. And the reason I'm always buying is cash. If I were just to stockpile cash, I bet I would squander some of it. So the beauty of me always buying is I'm always getting closer to my goal. And quite frankly, I have the confidence, I have the comfort of having some of these gains behind me, like this one, some big gains. And because I have big gains, if some of the stocks I'm buying in 2018, they go underwater a bit, so be it. So be it. It just doesn't bother me as much as if I were just starting out from the beginning. And so that's the difference. You need to think, are you like me with some gains behind you? Are you just getting started? It may affect the strategy. The strategy may be a little bit different, taking all of that into account. What else? Capital allocation. Things are different. I have 2 kids now. I have a family. I have responsibilities. A lot of responsibilities. Back then, I still had responsibilities, but look, we didn't have the kids. I was focusing all of my capital being deployed on basically Reynolds, Altria, and a few other similar companies, mainly focusing on this one industry. I didn't have a lot of cash on the sidelines. I'll link in the description below how I went all in. I had an all-in strategy. Things are a little different now. I'm still more or less all in, but I'm building an emergency fund, and I have a well-diversified portfolio of 38 stocks. And so things are just different. I've evolved as an investor. What I did back then made sense. It made sense at the time, but where my portfolio's at, where my life's at, I'm a different investor now. I have different goals. Certainly a lot less prone to taking risk at this stage. So you want to think about your own situation. Where are you in your investing life cycle? Are you towards where I'm at? Maybe you're further along than me. Maybe you're living off of cash flow. Maybe you're just starting. It really depends where you're at. It will totally affect the type of strategy. I'm just sharing my personal journey here and just how I've personally evolved as an investor. What else? The dividend. This is what I love this. A lot of people think dividend stocks, they can't experience capital appreciation. They can't beat the S&P 500. They can't do this or that. There's a lot of kind of negativity against dividend investors. It oftentimes comes from these tech investors. And look, I respect all investors. If tech works for you, FANG works for you, great. I commend you. I want everyone to find the strategy that's best for them. But at the same time, when dividend investors get labeled as boring investors or investors that aren't going to beat the market, they're not going to beat the S&P. Why would you do that? Why would you invest in dividends? Well, here's an example. Totally beat the S&P. There's no denying it. It's possible with dividends. It just matters when someone buys, and it matters what type of company, just as it would with a tech stock or a FANG stock. What else? I may be really different than someone starting now. We already talked about this, but I really want to hammer home this point. So I'm not starting out now. I've been investing for over 20 years, and there was a time when I was real focused. Like I said, these days I'm not. I have these gains under my belt. I have that confidence that, look, I'm just underwater potentially on some stocks I buy in 2018. Let's say the next crash hits 2019. Just doesn't faze me. And the beauty, though, the takeaway here is maybe you're just getting started. It gets better. That's what I love about dividend investing. Once you have some gains under your belt, once you have some of these winners like this one, they'll come eventually. If one's real prudent about their research, they buy at the right time, they get good at the craft, they hone in their skills, it will happen. And once that happens, you're in such a good place. That's what I feel. I'm in such a good place now because I've got some of those gains under my belt. It just makes the whole thing more fun. But if I were just starting out now, I would feel differently. I would probably feel a little bit differently than, and I might be even doing things a little bit differently than what I'm doing. And so the homework is everyone needs to go home, think, write it out, journal it out. Where are you? What type of strategy do you want to take? It's going to be so different for everyone. It's not a one size fits all. And what else? What I'm doing in 2018. What am I doing with these stocks? So when RAI got bought out by BTI, like I said, I kept my shares in BTI. I already owned shares in BTI. I bought more shares in BTI and similar companies. I kept the money in the sector. But for the longest time now, for the last few years, I've not even been reinvesting dividends in this sector because the valuations got real lofty. Now that they've come back down to reality in the last year, I started reinvesting dividends again. But I'm not buying these. And the reason I'm not buying is I have a big chunk, a big allocation to this sector already. I just don't need more. Takeaway is I own 38 stocks. A bunch of them might be on sale at any time. Just because something's on sale doesn't mean I need to buy it, because it's a game of capital allocation. And if I'm already over-allocated, real over-allocated in any one sector, I don't need to add more to it. So the types of values I'm buying now are IBM, Cedar Fair is some examples, but I'm not buying BTI, Altria, et cetera, et cetera. I'm not buying those stocks right now. I hold them as I mentioned here, but I'm not buying more of them because I don't need more allocation to that sector now in 2018, even though they are trading in the scheme of things at a reasonable valuation, in my opinion. Yeah, we're in a lofty market, but within the lofty market, they look like reasonable values to me, and that's why I started reinvesting the dividends again. So I'd be curious, have you ever hit the jackpot? Have you had jackpot style wins in dividend investing and in other types of investing? Would love to hear your success stories below and your not successful stories. Let's share all of our mistakes as well. I know I've had my fair share and I share them over time. I shared one just in my last video in Vegas, so check that out. What else? Before I leave today, in terms of a full disclosure, I own stocks mentioned today. I am long. I own shares of BTI, ticker symbol BTI, Altria, ticker symbol MO, Cedar Fair, ticker symbol FUN, and IBM, ticker symbol IBM. I own those stocks in my personal stock portfolio. Also, I'm not a licensed investment advisor. Today's video is not investment advice. This video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Literally just sharing my journey here on YouTube. Hey, boy, I hope this turns out right. This is the third time I'm filming this video. I filmed it just a minute ago. It didn't turn out right. The audio was messed up. I filmed it earlier this week because I was traveling for business. Didn't turn out well. Life of the YouTuber. I'm praying this is it. If you enjoyed this video today, and quite frankly, if this isn't it, the audio's messed up, something's messed up, I apologize. I gotta just wrap it up. But this is the life of the YouTuber. If you enjoyed the video, I'm telling you, the thumbs up, the subscriptions, comments, the support, it means the world to me. If you could do me a favor, head over to my Instagram. I'll link in the description below. Follow me there. It means the world to me. If you comment on my Instagram and you're in the dividend community, I will follow you back. And so let's build community there as well. I'm sharing stories actually on Instagram, and each day, each few days, check out my photos because I usually have some text with them. And in the text, I'm sharing personal insights from life, from business, from investing. Good stuff. Good stuff, net new stuff that complements my YouTube channel really well. So thank you for the support. The community here, it means the world to me. Let's support each other. Let's be the best possible dividend investors, cash flow investors we can be. And let's embrace these RAI style gains. I will see you in the next video.